Hi, I'm Abolawe. On today's episode, we'll be looking at business transaction and source documents. So let's begin. Uh, Business transaction, let's start with business transaction. Is the exchange of value between a knowledgeable buyer and seller at arm's length. So business transaction usually involves a buyer and a seller. And in every business transaction, one party must be giving and the other party must be receiving. So because it's financial accounting as a course that we are talking about, and it has to do with money. So the buyer most often is considered the giver because the buyer is giving out money. So the seller is often considered the receiver in every business transaction. So when a business transaction involves an individual and a business organization, we call that formal business transaction because in the process of it, a source document, or we call it paper document, is often generated in the process, which serves as a reference or evidence that a transaction has truly taken place. So a business transaction between individuals and business organization is formal business transaction, or between two business organizations. Let's say GT Bank transacting business with First Bank. That's also a formal business transaction. So that's with respect to business transaction. Then let's move to source documents. Like as you can see, source documents are documents of reference that provides information about the financial transaction between a buyer and a seller. So source documents are often generated during a business transaction, and the moment these business transactions are generated from these source documents, then they will be subsequently recorded in the appropriate subsidiary books. So source documents are documents of reference. They are documents of evidence. And don't forget, in every formal business transaction, that's when source documents are often generated. Now, every time a business is involved in a business transaction, there is always a document or paper document that is often generated, and that is called source document in bookkeeping and financial accounting. And source document is very important in bookkeeping and financial accounting because they serve as evidence that a transaction has truly occurred between a knowledgeable buyer and a knowledgeable seller. Also, in auditing, the auditor needs to have access to the various source documents in order to be able to reaffirm the accuracy of the balances in the company's financial statement. Like we did say, the auditor, the duty of it is the responsibility of the financial accountant to prepare the financial statements. Now, the auditor serves as a check on the part of the financial accountant. That means the financial statement which the financial accountant has prepared, then the auditor will examine it by making sure that the financial statement, the records in the financial statements, aligned with the appropriate source document, which was provided by the auditor, uh, from the accountant of the business organization. So, as a bookkeeper or as an accountant, you are saddled with the responsibility of ensuring that source documents are kept and stored for future reference. So as an auditor, as a bookkeeper, make sure all these source documents are kept and stored in or for reference purpose in a file, well-organized file. But nowadays, you may ask if these source documents are still in paper form or in electronic form, because most business nowadays, they are going technology. most business transactions nowadays are affected by technology. So most of the source documents, unlike before now, we usually or we used to have them in hard copy, but nowadays most of them are in electronic form, whereby they can be traceable through electronic form. So most times when you buy items in supermarkets, you may not be given the receipts in hard copy, but through electronic what form. So that's basically with respect to source documents. So they are generated during a formal business transaction, to be precise. Now, like I did say, there are some source documents that have gone extinct. That means they are no longer in use in business transaction, but there are still some that are still in use. So we are going to be talking about those ones that are still in use. Then we will try and highlight the importance or the uses of each of them as we get along. Now, just a reminder that if this is the first time you are coming across our video, please do subscribe to our YouTube channel, ring the bell so that each time we produce or we release a video, that will come straight directly to your smartphones or to whatever gadgets you are using. So thank you all in advance. So let's start with the first source document we have, which is invoice. So invoice. Invoice is often sent by the seller to the buyer, showing the details that the seller has dispatched to the buyer. And some of the details could include the description of the goods, the unit price of the goods, which was agreed between the buyer and the seller, and some other terms of sales, which might have been agreed by the or between the buyer and the seller. Now, this same invoice, most times it contains an abbreviation. Abbreviation on the invoice, we find most times abbreviation E, E and OE. This E and OE is an abbreviation on the invoice, and it means error and omission exempted. What this abbreviation means is that if there is any likely error on the invoice, it will make it possible for that to be corrected on the invoice. So it means error and omission exempted. So if there is any error on the invoice, this abbreviation will make it possible for it to be corrected on the invoice. And with respect to invoice, each time it is issued, it serves as source of information for sale. That means you have sold goods to your customer. And on the other hand, when you receive invoice, it means you have purchased. So invoice serves as source of information for sale if issued, and source of information for purchase if received. So next, voucher. Now, in every organization, there are funds that they need to be spending on petty expenses or big expenses or main expenses. In every organization, for spending to be authorized or for spending to be made, voucher must be raised. So voucher is a source document that is often raised to authorize spending of money in any business organization. I mean formal business organization. So voucher has two classifications basically. The first is petty cash voucher. That petty cash voucher is usually raised to spend small expenses. That's petty cash expenses, small like postages, uh, petrol, and all that. And the other classification of voucher is main cash voucher. That main cash voucher is used to spend major expenses or is used to authorize major expenses of the business. Like perhaps the business wants to purchase motor vehicle or plant and machinery. Then in that case, main cash voucher would be raised. So some of the information you will likely find on a voucher are the the person authorizing the voucher, that's the petty cashier. Then the purpose of spending the money, that means on what the money is to be spent on. Then the name of the bank on which the voucher will be drawn and other information will be contained in a voucher. So next, receipts. So anytime a business makes sales, receipts will be generated in the process. So receipt is a document that acknowledges money received or money paid for goods and services. So when we talk of receipts, most times it is a major proof of uh, uh, payment. That's receipt. It's the major source document in accounting that shows proof of payment. So anytime payment is made, you get a receipt. And anytime sales is also made, you issue out a receipt. So I want to believe everyone watching has been uh, given a receipt before or has seen a receipt before. So that's basically what a receipt means. So it's the major source document in accounting or in bookkeeping that serves as proof of payment. So the next, number 4, deposit slip, which you can also call paying slip. So most times when you have a bank account, you want to pay money into your bank account. There is a form which you are going to fill, and that form is deposit slip or paying slip. So paying slip is the form that is filled to deposit money into the bank account. And some of the information you will find or the details in a deposit slip could include the name of the bank, the name of the account holder, the date of the transaction, the amount in words and in figures, space for authorization, and so on and so forth. So this deposit slip most times serves as a source of information for updating the cash book. So most times when you want to update your cash book, you can make use of deposit slip or paying slip to update it because it serves as source of information for cash that had been paid into the bank account. Then the next, statement of accounts. Statement of accounts could also be called bank statements. And bank statements is a periodic statement. Periodic means it could be given by a bank to its customer weekly, 2 weeks, monthly, and all that, depending on the volume of the transaction. So bank statement or statement of accounts shows the financial summary between a customer and its bank periodically. So most of the information you will find on the bank statement is how the customer has deposited money in the bank account, the money he has withdrawn, as well as the balance in the customer's account. So most times, bank statements or statements of accounts can be used to prepare the bank reconciliation statement. That means you have to reconcile your bank statements with your cash book. Then that will enable you to prepare your bank reconciliation statements. Next, debit notes. Debit note is a form of invoice, and that's why we call it supplementary or additional invoice. That's debit note. So it is usually issued in addition to the original invoice, particularly when the account of the customer has been undercharged. So this debit note, it is used to correct error of undercharge. Undercharge in the sense that, look at this. Let's say as a customer, you order goods of 5,000 units, 5,000 units, and you were supplied 4,500 units. What that means is that your account had been on the charge by 500 units. Let me display how the account usually looks like, how the entry are usually being passed. So let me put it here. Let's say this is the customer's account. You order 5,000 units and you will send 4,000. The customer receiving means that his account will be debited. Like you all know, every receiver must be debited. Debit the receiver and credit the giver. So the customer is receiving 4,500 units. So this is the customer's account. Excuse me. So let's say, so that you all can see it clearly. So let's say this is the customer's account. Customer's account. Customer's account. So the customer is receiving 4,500 units instead of 5,000 units. So the customer's account will be debited with 4,500 units. Now, the customer's account ought to be debited with 5,000 units because it ought to have been supplied 5,000 units, but it's been supplied 4,000 units. Now, the remaining 500 units, the supplier will now issue a debit note. This debit note means that while the supplier issues the debit note, it will be accompanied by the remaining 500 units. And that means the customer's account will now be debited with additional 500 units. So then in this account, you have, let's say, 5,000 units. Then you have your balance carried down to be 5,000. Then you close the account. You have 5,000. So closing it. Then balance brought forward, which is 5,000. The balance carried down. So most times, debit notes usually originate from the supplier because it is the supplier that will get to know that the account of so-so customer have been on the chart by so-so units. Then it will issue a debit note accompanying the units by which the account of the customer have been on the chart. So, but if debit notes originate from the customer, it's usually in respect of the goods that the customer purchased from the supplier. So in that case, if the debit notes now originate from the customer, it means the account of the supplier in the book of the customer will be debited. That means it will be reduced. This is how it looks like. Excuse me. So let's say the account of the supplier in the book of the customer. This is how it's going to look like. Supplier's account. So supplier's account is often credited because it's assumed to be a creditor. So that 500 units by which the customer's account has been reduced will now be debited because ordinarily this is what you have. Okay, you have 500 units in the supplier's account. That means in the book of the customer, the supplier's account will be debited if the debit note originates from the customer. So that means the supplier's account will be reduced by 500 units because the supplier ought to have supplied him 5,000 units. The supplier supplied the customer 4,005. So the actual units now, the customer will have to remove that 500 units to make the account or the balance in the supplier's account to be 4,500 units. You will get to understand all this when we get to double entry system of accounting because we are going to be playing with questions on debit, credit, and all that. So that's with respect to debit note. So debit note is used to correct error of on the charge. That means when the customer's account has been reduced, then you now want to increase it. You will issue a debit note. Then 7, the next one, credit notes. So credit note is the opposite of debit notes. And most times it is often used to correct error of overcharge. Error of overcharge means, error of overcharge means a customer requested, let's say, goods of 5,000 units, and the customer will supply 6,000 units. Look at this. As a customer, you requested 5,000 units, but you were supplied 6,000 units. What that means is that your account has been overcharged by 1,000 units. You have been supplied in excess. That's what it means. So now that the customer's account ought to be 5,000, but you have been supplied what? 6,000 units. Then that means the customer's account will be reduced by that 1,000 units. Now, customer accounts, we always believe it to have a debit balance because your customer will eventually become your debtors. So debtors is a current asset and all assets are debited. So if you want to reduce an account that has a debit balance, then you have to credit it. And the same, if you want to reduce an account that has a credit balance, you have to debit it. So here now, to reduce this customer's account or anybody's account, but let's limit it to customers' accounts in this respect. So here we have the balance now. We have error of overcast, that's overcharged by 1,000 units. So in the customer's account, crediting it means you have reduced it. But debiting a customer's account means you are increasing it. That's just it. We'll get to talk about all this when we get to system of double entry or double entry system of accounting. So let's move on. So credit notes, most times when discount that was not allowed is not allowed, credit note is used to correct that. So it's used to correct error of overcharge. That means when an account has been increased in excess, that's basically what that means. Or the customer has been supplied more than he ought to have been supplied. So to reduce the customer's account, a credit note will be issued. And if you want to reduce a customer's account, you credit it. More of a debtor's account. Then the next, check stub. Check stub is also called check counterfoil. Check counterfoil. Check counterfoil. That's another word for check stub. And we all know what check means. A check is a written order drawn upon a bank to pay some certain amount to a named person or business organization. But check stub is quite different or counterfoil. Let me describe it on the board so that everyone can get to have a noting acquaintance of what check stub means. This is a check. This is the check. Let's say this is a check here. Then there is always a part of this check that is often perforated, small. This is the main check from here to here. This is the main check here. Then from here to here is a check stub or the counterfoil. Now, the information in this check stub is the same with that on the main check. So most times when you draw a check on a bank, the bank will detach this. They will have this with them. Then you as a customer will have this with you. That means you will have this left on your checkbook. So this check stub is a small part of a check that is left in the checkbook after the main check has been detached. Then what's the main use of the check stub or counterfoil? It serves as a way of getting to know the number of checks that have been drawn on the bank. And also you can use it to update the cash book. You know, cash book, 2-column cash book where you have date, particular, folio, cash, and bank. This can be used to update the cash book with respect to the cash that had been lodged with the bank or paid into the bank account. These can be used to update the cash book as well, but with respect to check. And you can also use it to update your check register. Check register is a list of check received and check paid for the period, perhaps weekly, monthly, and all that. So check stub is a source of information for updating the cash book with respect to check issued or check received. And that's talking about check register. Then next, Claim form. Claim form, from the word claim. Now, most times when an employee is on duty and he spends money from his own purse for the benefits of the company, so such money should be paid back to the employee for having paid such money to benefit the company from his own pocket. So such form that such employee will provide to serve as evidence that he or she has spent so money is claim form. So claim form is that form which an employee provides to recoup or to regain whatever money that he or she has spent while on duty for the benefit of the company. And a good example of claim form, which can serve as evidence that the staff or the employee has paid a particular money or has incurred a particular expenses from his personal purse for the benefit of the company could be receipts. Receipts, perhaps that was received when he paid the money for the benefit of the company. So that's basically what claim form is about. It is that document you as an employee have to provide for having spent money from your own personal purse for the benefits of the company. So a good example could be receipt, like we said, because a receipt acknowledges money that has been paid or received. So these are some of the source documents that are still in use. And like I did say, some of them uh, may not necessarily be in paper form, but traceable through electronic means and all that. So as an accountant, you must make sure that all these source documents are readily are stored and kept for future reference. Should the auditor comes around and ask of all these documents with respect to all the transactions that you have recorded on the financial statements, because the auditor serves as a check on the part of the accountant. So don't be that accountant that will always want to exchange blows with the auditor because you couldn't provide one or two source document that was requested by the auditor. I think I once worked in one consulting firm like that where I witnessed it. I witnessed an accountant and the auditor trying to exchange those. That's by the way. Let's move on. I know you want to get the full story of that. That's another time. So these are some of the source documents that we're going to be talking about. Then let's talk about features. Another one for features is characteristics or qualities or properties of source documents. And what that means is that source documents as a paper document or evidence or means of reference, most times they possess similar qualities that some want to say, oh, this is a source document that is used in bookkeeping and accounting. So those similar features or qualities or properties of each of these ones that we've explained are these. So number one, we have name. Each source document must contain the name of the business organization on it. Let's say you are buying from Boku Mart. You will see when you are being given a receipt, you will see the name of the business organization there. That's Boku. Then most times you will see the address, name and address. After the name, you have the address of the business. Or most times at the overleaf, that's towards the end of the receipt, you will see the address there. But most times you will see the name at the top of every source document. Then the next, date. The date the transaction occurs is often stated, like I did say, that in bookkeeping and accounting, we value dates a lot. The date the transaction occurs, it's very important. So the date will be in any of these source documents that we've talked about. You have to indicate it. Next, authorization. There is usually space for authorization in every source document, and that means space for signing between the two parties involved. That's the buyer and the seller. So in every transaction, you will always have two parties, or most times three, and all that. So the space for authorization, that's what it stands for. You have to sign, the buyer will sign, the seller will sign. Not in all cases, but in most cases, you will have space for authorization in most of these source documents. Then number four, amount. Yeah, the amount of the transaction has to be stated both in words and in figures. In words, maybe the transaction is 5 million naira. It will be written 5 million, like that, 5 million naira. Then this is in words. Then in figures, you will see 5 million naira. Perhaps it's in naira or dollar. It should be written. So the amount is often stated both in words and in figures. Then lastly, we have description of the goods. Description of the goods. Perhaps the list of the items you bought. It will also be stated on every source document. Perhaps, let's say you are buying a white board marker, or you're buying, let's say, a colored television, or a flat screen, or you're buying a list of items. Let's say you're buying toothpaste, toothbrush, you're buying bathing soap, and all that. So the description of the goods will likely be stated, or perhaps in color. You're buying blue, red, all those will be stated. That's the description of the goods. So I think you've all have learned one or two things in today's episode. We've talked about business transaction, source documents. We've talked about the source documents that are still in use. Some are not in use, some are still in use. So those ones that are still in use, we've talked about them. And don't forget, some of them are now in electronic form, unlike before, where we used to have them in hard copies. Then we've talked about the of features that are peculiar to, that are similar to each of these source documents. So I think this juncture, I have to say a big thanks to everyone for having stuck with me this far. Please, I'll keep reminding you all, please subscribe to our YouTube channel, ring the bell, so that each time we put out a video, you will get a notification for that. And please don't forget to share our videos to friends and relatives, that this may be of tremendous help. I will see you on my next episode. You have a good one. Bye bye.